Face Warriors and Investing.com viewers. How's everyone doing today? Of course, the feature is what's happening in the UK, expressed by candlesticks to the downside in cable. So I'm going to let the guys that are good fundamentalists like Stelios and Steve discuss the chaos in the UK and the fact that confidence is beginning to wane. I hear someone's mic.
That would be mine, sorry.
Oh, that's okay, buddy. So, we're not at new lows yet, but for me, with these kind of tape bombs, and it's a no touch for me. So there's enough things that I could find that another request for Amanda by Ben, and just another trade that you can avoid. You don't have to be in everything. And when things become chaotic with these kind of candles, these kind of gaps, to me, it means prudence over valor. Don't try to be a hero. So we have a great guest today with David Brady. David's a highly followed strategist, CMT, and has been right about a lot of things I'm interested in, where his views are. So I've been playing the dollar from the short side this week, and it still to me looks like a correction. In fact, this looks like a bull flag. So I'm still looking for higher levels in the Dixie, actually pretty extreme higher levels, maybe up towards 100 going into year end. And we'll see what happens here. This to me, even with the dollar coming off, it's been corrective and slow, and we've rallied 140 pips in the euro, but really doesn't change it. Euro has a similar line coming in around the 110 level. Actually think before it's over, we'll see 78.6 back, which is right around that 108.70 level. And then perhaps a major dollar peak, major gold bottom towards year end, or shortly after the Fed meeting, because I do think that we'll get a Fed rate hike with a dovish statement. And that's going to provide relief and possibly put in a significant top. Even if the dollar does get all the way up here, you're talking about a lower high. Okay, and this was a pretty good break, 26 handles here. So even if we get up to 100, and normally if it's a C or a 3, you're going to end up with a fib extension of this move, and 1.618 is going to be almost 40 handles. So you're going to be talking about, this is 16. So you can be talking 25 from here, could take it all the way back down to 75. Big new lows down the road. I'm not sure what the catalyst is going to be, but I would say our relations globally, that people probably want more predictability than the dollar with what's going on here domestically in the U.S. And let's face it, in life, a lot of people like to see whoever is on top take a tumble. And, we've been a dominating power, not always, for the greater good either. And a lot of people would want to challenge our position, especially our world reserve currency status. So already hearing that there are some payments going on in euro. That's why China opened up their own oil exchange, and they have a gold exchange in Shanghai. So I think this is going to end up being a very critical, there's always trades, but if we fail to make a new high and start turning lower in the dollar, that's going to ripple through all the markets. It should be supportive of the commodity complex. Gold comes to mind. I had Angie Setzer on yesterday. The grains, which aren't as affected by Fed policy, hardly at all affected by any kind of Fed policy. So, grains could be a great strategic long coming up here. Just getting back to the Swiss, which was a turnaround Tuesday call, showed this rising wedge. The turn happened in Europe. Just grinding down, been a couple of trades. We'll see. It's actually acting, weaker, but I'm flat right now, anticipating a higher dollar. I think I'm through playing the short side. It wasn't easy, you know, and even if you caught the euro bounce, you know, you had a lot of candles, especially where was that one candle that really made you think that it was over. Yeah. Well, you had a break where it looked like it was over. Then here, now we're fighting our way back. It's chop. To me, this still was a confirmed low on a 4-hour time frame. So relatively no divergence on the 1 hour. So I think just like the dollar make new highs, euro's going to make a new low. I'll begin to pare back my dollar bullishness if we could get closes back over 13.5 in the euro USD. And as you can see, with a little dollar weakness, we had a bounce in gold. Old support became new resistance. And I also, for people here that are hearing my voice in the room or through the live stream at investing.com, if you would have been a ForexAnalytix subscriber, you would have known from Greg Horvat's analysis back here on the weekend that this was about to happen. And he has lower targets for the completion of this. So, if you're in Bitcoin or cryptos that suffered again this week, spot on by the Wizard of Waves, Greg Horvat. And if you'd like to become part of our trading community, you can just sign up for a trial. It's a good time to do it during the holidays if things are slowing down for you at work. You have more time to learn how to navigate our website and get used to our traffic light page that has all the analysis. Webinars online, of course, where else would it be? So you take a look at, we have Elliott analysis, harmonics, basic technical, candlestick, and macro. And we have all the takeaways about any instrument you want to take a look at. It's all at your fingertips. We have a great community. FACE is only an hour and a half of the day of the trading day. First hour is analysis by the team. And the last half hour is an interview with a guest. I try and find people that bring great ideas and content to our community. Again, it's all part of intelligence gathering. So don't isolate, collaborate. And I really can't think of a better place to go to collaborate during the day than our chat room for members. I guess we could call it private. It's not private. You just have to open up your wallet or use your credit card to get that type of input that we get from our trading room. And there are many people in here that they trade for a living. I'm sure there are people in here learning how to trade as well, but so many pros, usually about 100 in here. As you can see, guys, Jumbotron, you're on. Who on the Jumbotron? Give me a reason why you're in here every day, even though you don't have to, because you know how to trade. Why are you in here? Anyone have an answer? Fractals, baby, Steve, Natish, all your regulars, and many of them have been here for years. So in an industry where there's a lot of turnover and people looking for the Holy Grail, which doesn't exist, I'd say that many have found it right here. So this is part of the package. Also, I just want to draw your attention to one other thing, and that's our sponsor, Forest Park FX. And they're a broker of brokers. They know them all. They've done due diligence. You could save yourself some time by calling Trent and Justin if you're considering opening a second account or moving your account for, there's multiple reasons. Could be the platform, could be the spreads, could be the research, whatever it is. You could call these guys directly. They'll get right back to you. And with that, yeah, hi, Steve.
I'm actually their client since yesterday. I wanted to do a lot earlier, but I wanted to have a conversation with Trent, and I didn't have the time. So I can tell you as a fact that I'm using them now. I mean, I wanted to do that since, as I said, a long time ago, but wanted to have a long talk with Trent, and I didn't have the time until yesterday. So now that we had this talk,
So are
I
you
settled.
moving your account somewhere?
No, as it seems, I'm staying there. But as I've said, you can stay at your current broker and just add them as your introducing broker, and it can happen very easily. So after we had a big discussion, we
So you
decided
get
that
rebates. You'll get
yeah,
rebates.
yeah, it was
Okay.
fine what I was for my type of trading, because we had an extensive look at my trading records and everything else, and I just added them as an introductory broker. It's extremely easy to do.
Oh, okay. All right. Well, thanks for giving us a live testimonial. Yeah, there was someone in the room last week who said he got his first rebate check. He loved it. It's almost like getting paid to do what you're doing anyway.
Yeah, I'm just going to tell you that we calculated that I had this discussion with him in February. If I had actually switched back then, but I just wanted to have a more thorough check with him, I would have already made more than $1,000 in rebates. Just
Nice.
from that. Yeah.
You don't need it though.
Nobody says no, right?
What are you gonna do? The $1,000 bills are like matchsticks to you, buddy. Anyway, great trading again this week, Steve. Holding S&P shorts. You did very well on the short side of crude, and then something you normally don't do, bottom picking it, and it looks like you might have a decent trade working. So
and the Aussie Kiwi got finally hit its target, and so yeah, it's been a couple of good months. You know how it is. It is what it is. Sometimes you get better luck. Sometimes, it cycles. Yes.
Like the markets.
The important is consistency. It's sometimes you're going to have better months, sometimes worse, but consistency is key, as Blake can testify more than anybody else. So I don't want to eat through his time. So because you know how limited it is.
Yeah.
So Blaker, what do you have for us, mate?
Yeah. What do you got, man?
Well, I was doing a little bit of work on the cable and like longer term stuff, and and good morning, guys. By the way,
good morning, buddy.
So what I do from time to time, and let me grab chart really quick.
Oh.
So if you use TradingView, and by the way, just so you guys know, I use TradingView for my charting package. I have as I can pull over here, you can see that, and I can pull over here. Like, these are my Bloomberg charts that I look at intraday, and these are all 1 minute charts, so I can actually see 1 day, 1 minute. I can see very minuscule moves in the market. I'm going to put them back where they were at on my other screens. And that's what I use and I keep those as static so I can kind of see as things are happening. But I like to do my chart work on TradingView because it's an easier platform for me to use and to draw on. Done. Hold on 1 second.
Personally, I hate Bloomberg charting. I remember telling you since years ago.
Yeah, it's very annoying, and I mean, it's really and actually when I go back to New York for our holiday party to Connecticut, I'll have a chartist come out from the Bloomberg office and meet with me, but they're really very difficult to use, very just not intuitive. And
not efficient as well. Yeah, you need a lot more time to chart. Yeah.
So like for example,
Bloomberg took all the sugar out of it.
So if you look at that's funny, Coach. I like that.
Thank you.
This is my. These are the charts that I do my typical daily work on. Hold on, really quick.
Done.
Oh, and Blake, the beach ball seems to not be popping back out of the water as much. Maybe there's a leak when you have a chance.
I'll look at that here in just a second. But so this is where I keep like my normal, like if you use ForexAnalytix and you get your basic technical analysis, like let's say you have the most basic package of ForexAnalytix and you're just using the basic technical analysis candlestick macro. The charts that you see here, most of them are going to be mine or Steve's, and then and then Paulie and Amanda will join in every once in a while and post some intraday stuff. But the charts you'll see here are the ones that I'm working on all the time. Sometimes I have to take a step back, and so what I'll do is I'll pull up a different feed and I'll take a longer term view of the charts. So and that's what I want to do with you guys today, because the pound, obviously it's been whipping around all over the place, and this, you can see we're threatening probably a pretty key level of support here in the pound soon, especially if you talk about this being a wedge. Longer term, as long as we stay below 132 or 131.50, the risk is that we break lower, and then you have to start going out to the weekly charts and going, okay, well, where is, really where does this support come in? Because you take a step back and you're like, well, there isn't really much support through here, because if we get through the 126 let's just call it 127. We get through 127, really. You're looking at back to the low 120s. Now, why is that a risk? Well, obviously, as you can see, the very messy Parliament, Brexit, I can't call it even discussion or debate or whatever they were doing. But it's so funny, like the way that, and I've always laughed at this when you watch like the UK politicians debate versus like the US politicians. US politicians are they just, one person speaks, you don't get a lot of comments or oohs or ahs from the rest of the lawmakers. And then in the UK, it's like they make comments, and then the cooing, the oohing, the awing, the booing, it's entertaining to say the least. Anyway, but the problem is, and I got to get back to the charts here, is that the cable, and Theresa May is probably going to face a no contest vote. There's that, and the problem with that, well, there's so many problems that right now, you would think that a deal has to get done here soon, but it seems like there's going to be a no contest vote. And if there's a no contest vote, then what happens to everything that's been done up until this point in time? Do you go back to square one? As Theresa May alludes to, what happens? And I think that uncertainty is really going to weigh on the cable. And so at this point, you got to be a little very, very, very careful with the pound. And I think if the pound, really breaks through this 127 level, it's 126.50. I mean, we could really see some, a sell-off, quite dramatic too. And then a lot of you might go, well, what happens to the euro? Well, the euro, it's holding up relatively well, but for all intents and purposes, we're just back testing like the breakdown point. The euro gets below this 112, which is the big 618 here, is at 111.80. Things can get pretty ugly for the euro, and I'd imagine that if the pound, starts to break down, that it's going to eventually pull down the euro dollar, because you're going to see the euro pound, because the euro pound has been rallying, and I'll go to that here in a second. That's going to keep the euro somewhat elevated, but at the same time, the risk could be that the dollar just gets, pulled higher almost across the board. So, and frankly, I'm not sure what to do. I'm scalping around a lot this morning. I've been scalping the cable quite aggressively this morning, just trying to take a few pips here and there. But holding on to a position longer term is scary. It's scary when you wake up and the thing's down 200 pips right out of the gate. It's like all things have not gone well.
Pinkert,
in Parliament, obviously. And when I got up, yeah.
I think you're breaking up, mate. Are you on Wi-Fi?
Oh, am I breaking up a little bit? Yeah, I might have to switch back over to a different router.
Okay.
Well, is it still breaking up?
Now it seems better, but go on and I'll tell you if it happens again, because it happened for several seconds. Okay,
so what I was just saying is that, and I'll try not to move anything here, is that that I guess the problem is like where does that put the dollar, you know, and where does the dollar go from here? And I myself, I'm just kind of steering clear longer term of the dollar, because we are, you know, just to point out, you know, we are struggling as we get up towards the 618 retracement. There, as long as we hold above 97, there still is risk of the dollar index moving higher. So despite, you know, the divergent relative strength, you know, when you have this divergent relative strength, there's nothing saying that we can't go higher here and break out as the dollar index makes its way towards 100. So, you know, daily sentiment index is still very stretched. There's a lot of dollar bulls out there, but still at the same time, I think the risk is that the dollar, you know, as long as it continues to hold up here, it'll work off these overbought signals, and sentiment will, you know, ease a little bit, and then, you know, that just gives way for another leg higher in the dollar. So being long the euro or long the cable is very scary. So right now I'm just kind of focused more on cross rates. I did pick up the Aussie New Zealand yesterday. I think the Aussie New Zealand is this is the area you want to be long, right down here. We had a strong Aussie jobs report last night. You know, pullbacks to like 106.50. If you can get this, if you can get a move down here to 106.50, I think that's where you want to be long. If you saw the chart of the day, you know, as long as we're above 106, this is a multi-year triangle. And if you're, you know, if you're like me and you're like, okay, well, I don't feel comfortable being long or short some of these other currencies, that's probably the place to trade. I mean, you know, is finding some sort of cross rate. I mean, I give you an example. Yesterday, I was short the dollar Canadian because, you know, crude looked like it was bouncing, and you know, short at 40. I covered it because it's just too choppy. And then, you know, the risk is if the dollar really starts to you know, take off again, and you see the euro down towards 112 and the cable down at 127, you know, the dollar Canadian could very easily be trading up at you know, 133, maybe even 134 again. So I'm having, it's a challenging time with the dollar because there's so many cross currents at this moment that I think if you focus more on a cross rate, which I know a lot of our traders in our chat room do, and you know, like you know, Amir, Amanda, you know, JT, a lot of Rick, a lot of these guys and gals, they focus on, you know, some of these cross rates like the Euro New Zealand or the Pound New Zealand or the Pound Aussie, and the Pound is going to be a little challenging right now, obviously, because it's the Pound. But, you know, some of those other cross rates might offer you some great opportunities, especially, you know, you watch stocks. Stocks are, you know, obviously under pressure. Oh, that leads me to just one last thing I want to cover before I let you guys go. So here's the S&P. The S&P is closing in on a 618 retracement, and yesterday we came really close to the 618 here. Watch this 2685, which is only 10 S&P points away from where we're at. Again, if you're not trading like a CFD here, if you're using you know, the cash index, or let's say you're using futures, all I have to say is 10 points from where we're at right now. We break below that, no matter what your feed says, somewhere about 10 points below where we're at right now, we're breaking below the 618. And then, you know, a lot of people that were thinking, oh, here's a big inverted head and shoulder pattern. Yeah, not. And by the way, I don't like inverted head and shoulder patterns as continuation patterns, which in this case would be a continuation pattern. I like inverted head and shoulder patterns as bottoming formations after a prolonged downtrend. That is not what we're in right now. So I would be really careful with the S&P or risk in general if we break through that support. And then if that happens, then you have to be, you have to start looking at pairs like the Kiwi and the Aussie that have had really nice rallies as of late. Those might start to actually roll over. So you look at the Aussie and the Kiwi, these currencies are pretty resilient here, but they'll show failure, in my opinion, if stocks roll over. So that's why it's imperative that we keep a close eye on what's happening with the S&P and everything else. So with that being said, I wanted to pass things over to my colleagues, but I'll tell you, Steve, that's a pretty interesting conversation that you had with Forest Park FX, Trent that works over there with Forest Park FX. And if you guys don't do the reimbursement program, you can just go to our website and if you're non-US, if you're non-US, you can participate in the reimbursement program or cashback rebate program. If you're a U.S. customer, you can do the rebate or the reimbursement program. But if you want more information, contact the guys over at Forest Park FX. We have a lot of traders that are listening in right now that actually get rebate checks now.
Hey, Blake, Scott Pickering has a great testimonial. He said, Dale, FYI, I've earned over 10K in rebates off the reimbursement program.
Wow.
Scott.
That's awesome, Scott. And by the way, Scott, I hope your wife is doing well. I met Scott, Scott and his wife years ago. I'm talking like 10 to 12 years ago or something like that. It's been a long time. Good to hear from you, Scott. Anyway, I'm gonna pass it over to I'm gonna pass it back over to Steve and Stelios. Guys, good morning.
Good morning, Blake.
Good morning, guys. And by the way, we do have retail sales coming out in just 3 minutes. So I'm gonna let you guys take over, and everybody have a great trading session. And thanks for tuning in. Thanks everybody for listening in. We're here every day if this is your first time being here. So just click on the link tomorrow at the same time.
Absolutely.
Thank you, Blake.
Thanks, Blake.
Guys.
So Stelio, time for you to give us, before we get the retail sales numbers.
Yes, I don't think
give
I'll
us a little bit of the Brexit backdrop.
Let's hear your Twilight Zone version.
Yeah.
No, basically, so for people who haven't been following, I'll say some now and some after the numbers. We obviously had the agreement between the EU and the UK, May's agreement about the draft Brexit agreement, and that was, well, by many was not expected to happen. It did happen. Then most people thought it wouldn't go past the cabinet. It did, but now we're at the most difficult and seemingly impossible task of passing it through Parliament. Now, what's happened is that there have been already quite a few resignations from Conservative ministers and members of Parliament.
Two mainly, Stelio, right?
Well, yeah, basically Dominic Raab, the Brexit minister, which struck me as a little bit odd because he was the person really responsible for drafting this agreement with May, and it was drafted, and now he says I cannot really, I cannot back this, which was a bit weird, but anyway, there were, I think there were 5 or 6 already, so we seem to have a problem with May's leadership because there have been the 48 signatures needed, which is 15% of the Tory MPs have been found to make a vote of no confidence. And that's going to happen, and she needs to get a majority. I think there's 330 Conservative MPs, if I'm correct. She has to get a majority. If not, she has to step down, and there have to be new. There has to be a new leadership elections within the Conservatives. And as we saw a few minutes ago, Rees-Mogg, he made his claim to be the leader of the Conservatives. Now let's get the numbers, and we'll continue on that. Empire State was strong, retail sales is strong. Yeah, Philly Fed, I can't see yet.
Let's see. I'm gonna tell you.
But yeah, Philly Fed is weak. Overall, no, retail sales is strong. So let me guess that the dollar is rallying a little bit. No, it's
so
not.
USD yen isn't doing anything. Euro USD isn't doing anything. I see a little bit of
Metals are not doing anything. Yeah.
in cable, but cable is a monster of its own today. So we had retail sales 0.8 versus 0.6 expected.
Revision was lower.
Previous 0.1 revised to minus 0.1. Yes. Ex-auto year on year 0.7 versus 0.5. Yeah. So overall, I would say more or less positive data.
Yeah. Okay.
Yeah.
So
the market doesn't seem to care so much about it. Yeah.
Yeah. So basically, what's next for the UK? It seems that the first thing that is going to happen is the vote of no confidence with May. If she does not win that, then she has to step down. There is a 2-week cooling period, as they say, after which there are going to be elections within the party to elect a new leader, and then well, the most probable scenario is that there's going to be a new election, new elections in general, and the other alternative is that May remains, that she wins the vote of no confidence.
Daily Fed actually almost half of what was expected. That's actually quite abysmal. 12.9 versus 20.7, with the previous being 22.2. So a very fast deceleration in that. Initial jobless claims came in as expected. So yeah, Philly Fed quite abysmal. The rest was okay.
Yeah.
The question still you hear is, I really don't understand. I mean, I think the only reason they've been keeping Theresa May is because nobody wants to take the hot potato of her hands. Because in all honesty, I think that no matter how good of a job somebody does, at the end of the day, since Brexit is such a complicated thing to happen, and there's going to have to be a lot of compromises, and whoever doesn't understand that doesn't understand the most basic things in politics. So I don't understand why somebody would want to take the hot potato from Theresa May. I believe that no matter who takes charge of negotiating something different, their political careers are more or less going to be over. So personally, I really can't understand why somebody would want to step in at the moment. I mean, it's a very, very dangerous political situation, because no matter what you do, roughly half the British people will consider you failed in whatever deal you come up with. Because let's be honest, a lot of the people that voted for Brexit had very high hopes on what that would mean and how easy that would, that could happen. And since the reality is quite a lot more harsh, it's very likely that the deal they're going to get is much, much worse than the deal they hoped for initially. So, yeah.
Yeah, it's a big question mark. What happens? First of all, if Theresa May goes, is it positive or negative for sterling? It's very difficult to know, really. And and again, if there's going to be a no-deal Brexit, that also has to be voted in Parliament. It's not an automatic thing that there's no deal. May's deal is not accepted.
Personally, I think that if May leaves, it's going to be in the short term negative for sterling for one reason and one reason only, because definitely it pushes away the at least the timing for a deal, because then you need a new leader, then you need to put
more
things on the
uncertainty.
table. More uncertainty and prolonging this uncertainty. So I have no doubt that if May steps down, there is going the pound is going to suffer in the short term, no matter who replaces her, because you just get prolonged uncertainty. It's as simple as that. I don't think that the market cares about May as a political leader, or that the market's going to be worried that by losing May, the UK weakens in any sense. But you know how it is. Uncertainty is something the markets definitely don't like.
Absolutely.
So at least May seems to be trying to push something forward. If she goes, that means that then again we have a question mark of if the new leader is going to try to push something forward as fast and which most likely not, because they will have to renegotiate, and they might want to change things, and then
There's not enough time until March. All that. March is the end date, right? So it's very difficult now. And the other thing,
that's going to change.
You think that's going to change?
I think they'll have to change that. I can't see any alternative to that, honestly.
Okay. My view on the whole situation, though, another thing which I was thinking is that look at the situation how it is right now with the Conservatives in power, and Labour are still polling behind them. They're like 4 or 5 points behind Labour. It's insane, right? Based on all that's been happening and how people are not happy with how Brexit has been handled, and Labour are still behind. So what do I think will happen if we get to general elections again? Well, I think Conservatives are gonna, whoever is the new leader, I think they're gonna come through. But we have many steps before that. So the first step is the vote of no confidence, which looks like it's coming. I think they do have the 48 signatures, so I think that's coming. And then from then we take it one step at a time. What's for sure is that Sterling is really not gonna like what's happening.
Yeah,
for the next few weeks.
And something, I have the exact same view that Blake was showing before. If you remember, Stelio, we've had this discussion several times. Personally, this looks like a continuation formation to me. I personally believe that, the chances that this is going to end up breaking to the downside for another push lower is very likely. So, as I was saying yesterday, personally, I don't like to trade these whipsaws within this range, but I do think that a breakout is going to produce some decent follow through. So, just by looking at cable, there is a decent chance that there's going to be more weakness coming. And, a daily close below 127 is going to confirm such a scenario, in which case 126 should follow. But I doubt it that 126 might prove enough. We might see lower prices like the 78.6, perhaps at 124.40. But, if you want to look this as a corrective formation higher, somebody could easily argue that we're going to be seeing lower lows than the post-Brexit low. That would definitely imply a stronger dollar, because pound is a decent component for that. And as Blake said, obviously the euro pound, if that's the case, the euro pound can end up breaking.
Having a great day.
Yeah, it's having a great day. It can end up breaking above this descending channel and then propel higher once again. But it's impossible for the euro to diverge completely against the dollar in comparison to what the pound does. So I cannot fathom any real scenario under which, let's say, the pound is breaking to new lows, it's moving towards the 124 area or whatever, and at the same time the euro is, let's say, appreciating against the dollar. It doesn't seem that likely. So, even the price action here and the way it has stalled, even the possible interpretation, because somebody can, I've seen a lot of people look at this as a head and shoulders formation, which, yeah, it can be, right? It can be. And if that's the case, where the neckline is. So,
Steve, what's interesting is that everything is what a difference 2 years makes, because the two potential fear events, Brexit, the market sold off on and then rallied dramatically, and then the presidential election, the market went limit down and then rallied dramatically, and now Brexit 2 years later is, it's all unwinding the hope. And currently with what's happening in U.S. equities and trade wars and confidence, that the U.S. was a safe bastion compared to the rest of the world, that's beginning to unwind. So really, it's interesting, those two events that initially were a bit of a shock, that the market went on bull runs from, that the markets are coming back to those pre-event levels. Just something I thought of in my delusional trading mind.
Trump was elected when the S&P was roughly here where I'm showing. My personal prediction is that when we have the presidential elections in 2020, the S&P is going to be a lot lower than that. I can tell you that much. I'm not calling this a top yet, right? This can easily be a correction. We might see another high. But I'm very, very confident that by the next presidential elections, we're going to be in a bear market and in a recession. And let me reiterate here, I believe that Trump will have little to do with that. As I've said multiple
More about
times here,
the fiscal position of the U.S.
first of all, it's pure statistics. We've already been in the longest bull market in history and in the second longest expansionary phase business cycle in history. So even a reversion to the mean would call for a recession to be, sooner rather than later, and a bear market to come sooner rather than later. Add to that the most important part, which is the fundamentals, which, if it wasn't for monetary stimulus, we would never see that kind of recovery anyhow, not in time or in price distance. So, as I've said many times, I agreed with many of the things that Trump said as a candidate. For example, Trump was calling the markets a bubble as a candidate, and the economy a bubble, and the Fed, he was calling out the Fed for actually supporting artificially supporting the economy so Obama can look good, and the economy looked good under Obama. And now he's blaming the Fed for not for doing what he was asking them to do under Obama, and at the same time, he doesn't think the economy is anymore a bubble. He actually wants to claim credit for getting an economy which, according to his words, were a bubble. And according to his words, before he even closed like 1 year in the presidency, he started calling it the best economy the US ever had. Huge mistake in my opinion, because as I said, the fall is not going to be his fault at a big extent. But by claiming credit, for building this economy, then he has to take the blame for whatever follows, right?
Right.
So, yeah.
So how could we make money today, buddy?
First of all, I have to say I got limited out yesterday once again in the short position. I had built at 2690 because if you remember, I keep saying how important 2690 is. So
Right.
now I'm once again flat in the S&P. I wouldn't be surprised if we saw a rebound from here.
Me either.
Yeah, but on the other hand, I wouldn't definitely be surprised if we saw new lows from here. So 2690, a very important level. I'm going to be watching it. I think it's going to be a pivot point for what happens with risk in US markets today. So 2690, 2685, 2690, key area of support. And I think that, that's going to tell us what is to follow. I think that if we actually do make it below 2690, then there is no real support that should hold price from retesting 2600 before going lower. So, today is going to be a key day for risk. There is no question about it. Now, at the same time, you can see here a potential failure in the USD yen, although I wouldn't be jumping the gun. It's currently testing quite important horizontal support. I know that Amanda has been on top of this, and I know Amanda has been shorting, and people in the chat room know that, the USD yen. And as it seems, she might have a great day today. I think that if we make it below this horizontal support area, then we're going to be retesting this larger ascending wedge support. And if we make it below there, I think we should very, very fast find ourselves back down at 111.50, if not lower, perhaps retesting this broken trend line resistance as support, which is below 110, right? Regardless, there is still a potential that we can find support once again in this ascending trend line and push higher towards 115, 115.50. So I would be quite careful here. One thing is for sure, we're much closer to support than a resistance. So USD yen seems to be losing momentum here. Anyhow, momentum was, during all this move to the upside, every single time momentum was unimpressive. There's no question about it. That's why I kept on refusing to buy the USD yen, because I don't like the way it's been moving higher. It's this slow grind that has nothing to do with the impulsive moves that we were seeing in the past after we actually bottomed down here in 2011, right? So this does not look like an impulse to me. So I would be worried that there is more downside to come at some point in the near future. And obviously, if risk sours here, USD yen can definitely be affected, as a subsequent result. Now, yesterday actually we had a decent rebound in metals. I said yesterday that that gold was striving to keep a very critical support area. It actually did so. It even built itself with yesterday's candle. We built ourselves here a morning star formation on the daily chart. So far, this potential breakout has been saved by the bulls. That doesn't really change the fact that price action is definitely not impulsive. So even if we see another push to the upside towards 1260, as long as the price action is of the type we've been seeing so far, I think that the metal is eventually going to fail. Anyhow, as I was showing yesterday, platinum has already failed from this ascending channel. Silver has already failed. It did bottom out at the previous low. As I said yesterday, yeah, there is always a possibility of a double bottom, but don't forget that you don't build a double bottom just because you rebounded off the previous low. You actually need to also cross the boundaries of the previous range, right? So for us to be calling a potential double bottom in silver, we would definitely need to see prices close above roughly 1480. That would convince me that some type of a big rebound, perhaps towards 1560, is underway. Until then, the potential of a retest of this broken horizontal support resistance area and the broken triangle support area, this time tested as resistance, is a much, much more likely scenario, which could lead to more weakness. So I would be very careful at this area, roughly 1430, 1435, potential reversal, a potential rejection from that area. A pullback and rejection from that area is definitely going to be a bearish event. Now, I was thinking yesterday that what we have not checked rather lately is the bonds, so I want to have a look at them. But before I do that, let me see. Quadruple top in USD yen breaks to 115, fake breakout, bull trap. Yep, that can happen. David says that. David Brady says that, and yeah, I enjoyed our conversation last time with David, so I'm really looking forward for another one today. Retweeting, Dimitris says, if successive British governments hadn't spent decades taking credit for EU successes and blaming the EU for all their failures, maybe the British people would understand what they were voting to give up. What's your crystal ball saying, Stel? Who is going to be the next PM? Stelio Ben is asking, who do you think the next prime minister will be in case?
We talked about that a little bit, right? I think in the next elections, I don't see Labour winning. I mean, if they can't get on top now, how can they get on top when May, who is not hated, but she's disliked by, a big majority of people. If she was replaced by Rees-Mogg or somebody else, when maybe Boris Johnson might not do it. But, I think the Conservatives, if they're not behind now, I don't see them being behind in a new election. So whoever replaces May, if she goes, I think is going to be the next prime minister.
Do we have any, or is it too early? Do we have any idea of how many candidates might come up to try to replace May in case she steps down from the leadership?
Usually, there has been occasions where there's only one, but it's supposed to be at least two candidates. Now, given all that's happening, I'll be very surprised if it's only one candidate that gets, selected. So we know Rees-Mogg wants the role. So we're going to wait for.
I think it's his. I mean, I have no idea, but I'm thinking out loudly. I was saying to Andy the same thing, earlier today. I have no idea why somebody would want to take over this mess at the moment. I mean, the chances that they're going to end up hurting their political career in a way that is not amendable afterwards is very high. So
well,
I think
at this point, sorry to interrupt, but at this point, after all that's happened, what's the downside? You know, you take over. The worst thing is that, you know, you go to a no-deal Brexit. It's all a shambles. But really, you can always, you know, politicians, they're going to blame it on the people before them. Oh, they brought us to this position. If we had enough time, we would have done something different, etc., etc. So as the situation looks worse and worse, the risk reward looks better to actually come to power, right? Because if something good happens, even if it's slightly good, then you're going to look like a hero. I mean, I don't know. I don't know.
I still believe that people have higher expectations than they should. So I think that even if somebody does well, that's not going to be appreciated. That's my personal point of view. But you know, we'll see. We'll see, Stelio.
Okay.
You know,
Actually, Catherine is saying that he's just said he's not putting his name forward. If that's referring to Mog, then
5 others.
I missed that headline. I'm sorry. So anyway, I think it's going to be very fluid over the next day or two. So let's wait and see.
We'll see. And something tells me that that's going to keep the cable and any pound per, you know, whipsawing, you know, up and down, and you know, who knows? We might even get a breakout. Actually, we're not far away now from a breakout. It's less than 100 pips, and with the moves we've been seeing lately, and the ADR of the pair, that has definitely, you know, increased substantially. 100 pips is a move we can see easily within a day. So let's see. Okay, so let's have a look at the treasuries, by the way. So treasuries and bonds. So bonds, we were looking at this as a bull flag. So this seems to have played out, you know, quite nicely. In which case, I expect another move to the upside. Now, you know, the key question here is the following. Okay, we can see another move to the upside. Perhaps we can even see a test of this confluence of multiple, depends on in how many days it happens. It can end up being confluence more or less of, you know, triple confluence of resistances, because don't forget, this is a very large corrective formation here in the bunch. You can see it. So the question is, what happens from here? Do we get another rejection, or we finally get a breakout? As you know, my opinion about this kind of formations, this is definitely corrective price action. So eventually, I'm expecting a breakout to the upside. But, you know, that doesn't mean that the next test is going to be the one that's going to make it, because, you know, we were just a few weeks ago, we were testing this trend line again. You know, the bunds looked like being quite strong, and, you know, they failed spectacularly. You can see here how big of a move we had to the downside. So I do think that we might see some continuation higher in the short term, but I think we need to see a lot more to finally get a breakout from this zone, from this descending channel that dates back to 2016, right? So you have to respect this is a pattern, this is a formation that has been tested multiple times from the market and has proved its value. Now, on the other hand, treasuries did break below the triangle, because that was a triangle. They did push to new lows. They do seem to be correcting. So far, you know, this looks like a channel. So far, I have to say that I have no reason to be overly bullish. We might just simply get rejected from a little bit higher than we currently are. You know, obviously, you know, the fact that prices stalled for a long time here in the triangle, and then they follow through that they produced was not, you know, that much of a deal, shows that the downside momentum for the time being is waning. So to be honest, personally, I wouldn't be looking to do something with the treasuries, but there is no doubt that the trend remains lower. So I would be watching at this, roughly this level is 119.3, 61.8% of the last move lower comes roughly at 119.50. You know, I would be watching these levels. If we get some type of a rejection from there, I think we can easily be pushing to new lows, in which case I would be looking for the next extension, which might be the 127% extension of whatever that formation ends up being, or even the 161.8. So we need to be a little bit more patient. So far, as I said, the rebound doesn't look impulsive. we need to see a lot more to trust this. And keep in mind that don't forget that the bonds, the benchmark bonds, are more or less rallying lately, as you see, in sympathy of risk having turned lower once again. So it's also partly what they call run to safety now. How safe you can consider treasuries being. We've had this discussion before. Personally, I don't consider them that safe, but it doesn't matter. The market is conditioned to believe that, so it is what it is. Anyhow, I don't want to bleed into the interview, and I know that Andre is here. I think he is here. Let me verify. And he had one idea to present before we. Yeah, he's here, and he had one idea to present before we start the interview. So let me find you, Andre, and promote you. Okay, there you are. So
I think I'm due for a promotion.
you are. Indeed, you are.
Can I stop getting you guys coffee every day?
Hello, everyone. Hello, Dale, Steve. How are you?
Andre.
Welcome to the party. I know that you.
Thank you.
You were looking at something specifically, some type of a harmonic pattern you wanted to share with us. So what,
yes,
that might be?
We have a few. We have no time to cover them all, but I will try to.
Don't worry. We can give you more. We can give you more time.
Very fast. Yeah. Okay. No issues. Well, just because as you know, I trade based on Fibonacci levels. So based on the Fibonacci levels, we'll complete then those harmonic patterns. So oil is trading the 161.8 extension and the shark pattern completion point, which should force the price to print some relief, at least to the 38% retracement is what I'm expecting. And let me just give a very fast cover for other instruments. S&P, Blake has mentioned it. I believe it's building a kind of head and shoulder, an inverted head and shoulder. It can develop into an inverted head and shoulder, but no matter how, we still need a breakout of the previous structural resistance. So even if it fails, and I believe it can happen, we still need the breakout of the resistance, so to validate that as a potential pattern. So even though I believe it's printing something similar.
My only problem with an inverted head and shoulders formation here would be that the implied target would be
new highs,
new all-time highs.
Yeah.
And personally, I don't believe that this market is ready for new all-time highs. I'm not saying that it can't happen, but I'm saying,
of course, Steve,
that I believe it might take longer. You know what I mean?
Oh yes, it can take the time that it needs to achieve that level. But I don't trade as I mentioned before. I don't trade based on those forecasts. I trade based on the pattern that the market is printing at this precise moment, and I will try to take advantage from them. So this is yields. Building also and trading what I believe
nice range.
A nice range and a technical double top. I was expecting somehow at the golden ratio, the retracement from this swing, the golden ratio to act as a potential support to build this eventual inverted head and shoulder, which should force the price to go up. It can be printed at 78% retracement by manuals. The right shoulder can be printed at the 78% retracement, so it can happen.
So you believe that the resolution of this rectangle is more likely to be to the downside than to the upside?
I believe there's momentum to the downside. I still believe there's momentum to the downside. I need this market oversold, and I believe it can break that structure.
My other problem here is that I don't see the inverted head and shoulders formation thesis going along with that thesis in yields. In my opinion, it's either one or the other. I don't know if you agree, Coach, but I don't see those two happen concurrently. So
no. The only one will
Yeah,
will be
only one
treated.
will play out of
Yeah,
those two.
yeah.
I kind of favor a resolution to the upside if the S&Ps hold this 2680 level
Yeah.
and the yen stabilizes. And I think that'll be it in the bonds
Let's
for a
just
while.
do that.
That just a guess.
Hmm.
But I am a professional guesser.
And USD yen.
And what a good professional guesser, Blake.
Yeah,
The good thing is that USD yen and S&P are both at important levels as we
Right.
speak.
Yeah.
So we're going to know quite soon.
Oh, that's for sure, and that's why I only get focused on the patterns, so and the completion points, and I measure the reward or the potential reward, and then I measure my risk for that pattern, and I don't care about what will happen next. So I just take careful with the risk that we apply on our trades, and then develop the strategy. But based
as
on
they
what
say in military aviation, fire and forget.
fire,
like Maverick missiles.
No, yeah, fire, forget, and learn. No, fire, forget, and learn with those two, and with eventual mistakes that you commit. So that's true also. So dollar versus yen, it is now approaching the first target for this BAT pattern printed at 88% retracement. So it's now approaching a structure, previous structure resistance, small resistance here, and now with some bullish hidden divergence information. So at any point, I believe the 38% can act as a potential support level for yen, but on a daily and on a weekly time frame, you already know my views on higher time frames. I have shared that chart inside ForexAnalytix. There's a major pattern printed on a weekly in a structured trend line resistance. I've that pattern. It's not draw here, but I
where's
still believe
224 come in price wise on your chart? Yeah.
224 comes at, let me show you this time frame. Let me just so I have a few dollar related pairs pointing down. So I still believe, I'm not so sure if dollar index will print a new high, but answering your question, Dale, 114.73.
Okay, so just enough to take out that prior high.
Yes, for sure. That's enough to kick to be kicked at the reversal. No,
right.
Enough for that. And it
third
can
drive.
happen.
It'd be a third drive up there too, if it happens.
Yeah. So I have a few dollar related pairs pointing down at this moment, but as always, we can
have a look at those tomorrow, since David is with us.
So, interview.
So join us tomorrow.
Okay.
Thank you, Andre.
Thank you, Andre.
Thank you, buddy. Thank you, Andre. Great work, buddy. Steve, thank you. David.
You're not getting rid of me. I'm sticking around. I like.
Okay, David's fourth interview here in Face. So welcome back, my trading warrior brother. Looking forward to our conversation.
Can you hear me?
I can hear you, David. I could see you. First of all, I'd like to congratulate you on the new addition to your family a month or so ago. I believe you had a son, right?
Yes, my second son. Now I've got 2 girls and 2 boys.
Well, did he come out saying, "Daddy, hedge me"? Were those his hedge me our stock portfolio, protect my inheritance?
Well, hedge me from a fall because I actually delivered him.
Oh my goodness! Wow.
Yeah, my wife's a naturopathic doctor, and we have all of our births were at home. Wow. And on this occasion, the fourth occasion, she got her contractions wrong. They were 20 minutes apart before she got into the shower, and then she's in the shower. She opens the door and says, "Baby, call the midwives." I said to do that half an hour ago. What's the difference? I've had 2 contractions in the shower. You've only been in there 5 minutes. Oh, geez. So I called them, but they didn't arrive on time, so I had to deliver my baby. Yes.
What a beautiful thing to remember. Yes. Yeah. Oh, wow. All right. I would have fainted, but congratulations, David. And I want to also acknowledge that we had exchanged a few tweets, and was after the initial break in October, and you said, you know, I'm looking for a rally back into the 2800 resistance level, and I know that you were getting short up there a week or so ago. Seems like it was a while ago. And God, what a great trade. No heat, immediate gratification. Closed great that day, and now here we are at some pivotal support. Do you take partial profits after, you know, being up 100 handles in S&Ps?
Yeah, as I told my the members of my site, Global Pro Traders, I post all my trades on that site, and I bought 2 puts, a March 19 and a June 19. And why so long? Because I like to give myself room. I'm not greedy. I don't use lotto puts or lotto calls.
Right.
So I wanted to give myself room to, you know, in case we did get a rally and we did go to a higher high, because we'll get into this in a moment. But there are like 3 scenarios still out there.
Okay.
With regard to where stocks could go.
Well, great call, Dave.
Yeah, but I took my March one off when actually just yesterday, and I'm still running the June one. I actually bought a call at 26.92, I believe. Again, I don't believe in trying to catch the absolute bottom. I agree with the levels that have been provided earlier. By the way, I was listening the whole hour, and I love the dialogue, the information you guys were providing, Stylianos and Andre, and I was like dying to get in onto that. That's why I was posting my little chat messages, because I agree totally with Andre on WTI, and you know, Stylianos is making some great points too.
Yeah.
But yeah,
team.
I see this 26.83.84 is, as I've been saying on Twitter and on my site, is a big level. Now, it's not a be-all and end-all. We could break it and go down to the 26.50s or even 26.30 and then head back up. But it is a big level because it's a confluence of fibs, and both on an intraday and closing level. So I see the opportunity for it to hold here and go higher, but it could go lower. And if it does go lower, I'll be buying another call, because my view is we're still going to get another rally. Now, with that, let's get into this, because you know I'm talking ahead of myself, which I always do. And hold on just a second.
A picture speaks 1,000 words.
Yes, I'm having trouble minimizing your little. Where's the?
You're trying to get to some charts.
There's a little orange arrow at the top of the platform on the side.
God, I was using it earlier and I forget. Some guys like me can't multitask. Okay, so as my wife keeps telling me all the time. So yeah, here's the first scenario.
My wife tells me the exact same thing, and I keep answering to her that I don't want to multitask. I want to do one thing at a time and do it well. That's my answer to her.
And I say it's the same thing, but in a different way. Yeah, honey, you may be able to multitask, but I'm able to focus better on one thing, because that means whatever I do better than you. And then she doesn't talk to me for another half an hour. But anyway, that's. But S&P, this is the first primary scenario for me, which is that we peaked at 29.41 in wave 3 from an Elliott wave perspective, and we got the wave A of the crash in October, which we talked about way back in February, Dale. So it's begun if this scenario plays out. So we went down to the 2600, which was widely called, and I was actually surprised, because usually the market, you know, tends to play with us in terms of when it sees a consensus call, it does the opposite. But it did. It hit the 2600 level. And
or
then
that number becomes meaninless. It either doesn't get there or becomes meaninless.
Or plows right through it.
Yeah.
Yes, exactly.
Yep.
So we went back up to this 28, just short of this 28.20 level. And down we go again. Now, I believe that this is just wave B of B.
Right.
A smaller wave B, and we're going to go back up to either 28.20. My preference is for 28.60 or 28.90. And like Andre was pointing out, these are Fibonacci levels.
Right.
And,
that's about 78.6 up there at B?
Yes.
Okay.
76.4, yeah. And
okay.
you've got this inverted head and shoulders, and I just posted a message saying that I believe that this is going to be a false breakout. You know, the market likes to play with us, so it'll go north of it'll break this neckline, go up, and everybody gets all excited, and well, we're going back to new highs, and
that's what it measures, new highs, and it won't achieve it.
And then it'll just turn around and dump to 2100. It's called a bull trap, and that's my primary scenario for what's coming. I mean, if you go back to the forecast made in February, the key issue driving this is not the trade war, is ancillary. The global market contagion, we can get through the various triggers for or catalysts for a crash. But for me, it all comes down to one thing, and we talked about this. It's falling global net liquidity. Okay. The Fed is now reducing its balance sheet 50 billion a month, maximum QT. I saw a headline on Twitter this morning, and I've been saying it for a while myself, but the Powell will raise rates until something breaks. It's as simple as that, and that break is the stock market. So the potential catalyst for the next downturn could be the FOMC in December. It could be the buyback period in January, but there's another leg down coming. The issue we need to focus on now is where's the low here and when's the next rally? But global net liquidity is turning negative. You got the Fed is at maximum QT, talking about continuing to raise interest rates. You got the ECB saying they're going to taper QE to 0 in December, with a nice little contingency factor that if the world falls apart, we'll change our minds. And the BOJ coming out saying I think it was a week or two ago, saying that QE doesn't work, basically. So they're all talking very...
hawks everywhere.
Yes, very negative.
They ate all the doves. All the doves just got gobbled up. David, do you think that I'm not sure when the Fed meeting is in December.
19th.
Could okay, so it wouldn't take that long for us to retrace back up to that level, because a lot of people are hanging their hopes on a dovish hike, that they go ahead and hike and language changes that's more conciliatory.
Yeah, there's definitely, with the speed of the way the markets, where you just look at this chart and, that's,
could be there in Thanksgiving.
Yeah, that's you got plenty of time to get back up to that 2860 level.
Because I know you were looking for a December, January timeframe culmination of this decline. Are those still your timeframes? And I understand that if those are your timeframes, of course you'd buy March and June because of option erosion, time decay.
Exactly. And I think that's the December, January timeframe is the trigger for the wave C down. Okay. Where the culmination of the crash could be February. It's going to be pretty sharp, in my opinion, but it could be February, March. Hence why I'm going out a little further on my option duration. But yes, the FOMC could be the trigger. We'll get into that in a second. There's so many catalysts. Actually, we'll deal with them now. There's so many catalysts, Dale. I mean, you've got the G20 meeting coming up between the US and China, and I'll get into this when we talk about gold after stocks. But the risk is, they're doing the same thing over and over. They're talking a good game to prop up stocks, and then we get disappointed each and every time. I'm at least the market is starting to figure this out, but I think gold got a pop from it yesterday when they muzzled Navarro and said that the U.S. government was talking to China at all levels, and they received a message from the Chinese on what they're willing to agree to with regard to concessions. Then I saw on tweet this morning saying that it's not going to meet Trump's primary objective, which is the termination of this Make China Great in 2025 scenario. I just don't see how these two guys can agree. I think an agreement will be forced by a stock market crash, and I believe that China is relying on that. But that is one of the factors that could drive stocks lower on November 30th. If they come out and there's, Trump goes, okay, you guys aren't willing to bend, we're going to impose 25% tariffs on all Chinese exports to the US. And China just turns around and lets the dollar yuan go to 740, 780.
That's what I was thinking, yeah. Yeah, they said they would not weaponize their currency, which made me think, man, are they going to weaponize it?
Well, it makes I can't but giggle a little when I see people say, "Oh, China said that they're going to defend this level, and so we should believe them." Well, they also said that the rise from 624.50 on April 11, which was also the peak in gold, by the way, was driven by market forces. So who's to say market forces don't drive it to 740, 780?
Exactly.
You know, I mean, you can't take them at face value. The point is, if he proposes 25% tariffs on 500 billion or all of Chinese exports to the US, the only recourse really to the Chinese is to devalue the yuan. They've demonstrated that, and I think that may continue. The other factor, as you mentioned, is December 9th, the FOMC. They could raise rates. That could be another policy error. You got the buyback period, blackout period coming in January. That was the trigger for this fall. I've seen various explanations, but it was, I saw Goldman posted a tweet that was retweeted in late September, early October, saying 86% of companies are going into a blackout period in October.
And that,
and lo and behold, stocks went down. Why? Because liquidity is the only thing that matters to stocks.
That's a pearl.
It's the only thing. Stan Druckenmiller has been saying this for 40 years, 30 years. Don't want to belie his age, but it's the truth. And
Martin Zweig did too. You remember him? You're old enough to remember Martin Zweig. Yeah,
I do. Yeah. But then the buybacks come online, and they're not having a huge effect, but we are off the lows from 2,600. Well, the point is that we go into the big blackout period, having worked in the corporate sector. In January, which is year end, it's longer and it hits more companies, and I believe that could be the trigger for the next leg down too.
Okay.
Now, my friends on the call, Stylianos included, the Italy EU debacle is another, potential trigger. None of these are black swans because we all know what they are and what their potential effect are. The end of the petrodollar. As the US-Saudi tensions escalate, Saudis are pivoting towards China because China is the biggest buyer of oil in the world today. Who is the biggest competitor? Of
everything.
Of everything, but let's focus on oil.
I interviewed an agricultural lady yesterday, and they're stockpiling wheat and corn like Joseph did in the Bible.
Yeah, and soybeans too. But I agree. But, the petrodollar is the linchpin for U.S. hegemony in the world. And, to the extent that China is the biggest buyer, who's the biggest competitor to Saudis on the world stage in oil today? Guess
not us.
Exactly.
US. Yeah.
So our best friend is no longer our best friend. And now we've got this, assassination that's causing some, strife between the two of them. And Saudis, they want to make money on oil. The Trump is talking oil down, and Saudis need higher oil prices for higher revenues. So their interests are conflicted as well. So you've got oil has fallen, over 20% from its peak of 76.90 down to
what a relentless market move.
Exactly. So this can't make the Saudis happy. What if the Saudis, decide or in an agreement with China, we'll sell to you oil in yuan, and they officially state that they're no longer just going to solely price oil in dollars. That would be a game changer. So that's another catalyst. Then you got emerging market contagion. We all know about that. You got the GE potential bailout. I mean, they've got 110 billion in debt. Can they sell enough assets to pay that off? I don't know. You got potential Deutsche bankruptcy. And then
you're talking about General Electric.
Yes.
Yeah, those smart guys that actually decided to buy back their stock at the recent highs, and now they're like 15 billion under more than they were just because of buying their stock back at the wrong price. I mean, I can't even believe that they still allow buybacks. It's so market distorting. I mean, they're in deep trouble, and what do? They go ahead and spend their own money. I mean, and the pension for unfunded liabilities that they have that they don't have actually, and now they're another 15 billion down because their stock is crashing. I mean, the stock has become literally a penny stock. They kicked it out of the Dow Jones, and last time I checked, last week it was losing every single day like 5-7%. And I think that GE is one of the canaries in the coal mine. You know,
Yes.
I wanted to ask you, but I didn't want to interrupt you. I totally agree with your interpretation. I also don't believe that such a market move that like the one we saw, David, is going to be resolved as soon. So I do believe that there is more. Either we're going to create some type of a triangle here, or we're going to move to a new low. But my question is, what do you think? I mean, seeing already all this weakness spilling off to some of the major sectors, like, for example, mortgage application at multi-year lows, stock of unsold houses just going up, you know, as fast as possible.
I could answer that. David says we're already in recession several months ago, right, David?
Auto sector moving down. So how do you think, I mean, what do you think is going to be the catalyst of another move to new highs before the market actually crashes? Because the only thing that can come to mind to me, but I don't know if it's going to be enough if we make it all the way down to your target, to your C target, is Trump perhaps, because what Trump did when he came in power is that he tried to keep the bubble going for a little bit longer, this time through fiscal policy, because he knew that the Fed wouldn't play ball any longer. So he cut taxes, he increased spending, and now perhaps he's going to try to broker a deal with the Democrats about like infrastructure spending or whatever. But I'm not even sure that's going to be on time or enough to reverse the situation. I don't know. What do you think?
Well, first of all, I'll say this, Stylianos. I prepare a few post-its before I get onto these interviews, because I can't remember every bullet point. And you must have like a camera on me somewhere in this room, because my next bullet point was the whole housing market meltdown.
Okay.
So yeah, I agree with you. But the point of listing out those various factors for a catalyst to a crash is just to validate what you were just saying. There are so many shoes to drop here. So I posted a tweet literally yesterday saying, I don't know what the narrative can be to drive stocks higher. The only two items that I can identify right now to be used to push this market higher are the US-China trade war and a softening of relations between the two ahead of the G20 on November 30th. I thought that the market would ignore that because, you know, we've had so many disappointments already, but maybe they're willing to buy it again. But that's one. And the other one was the Fed starts talking dovish ahead of the December 19th FOMC. I didn't think Powell was hawkish yesterday. I felt he was dovish. He made some allusions to the fact that international growth was weaker and the housing market softening. He admitted that it's happening. Those 2 points. Look, the Fed is always optimistic. Overly so.
They never predict a recession, ever.
I have to stop myself from bashing the Fed every chance I get, because, you know, when I saw Powell use the term extraordinary economy, I knew there was coffee all over the wall in front of me, because it's just ridiculous. If you look at any solid data which can't be manipulated, like the federal tax receipts, as Dale alluded to earlier, they've been in and up and below zero since 2016, and you know, payroll receipts are negative. Yes, exactly. Yeah, they're massaging the data.
At a booming economy, you expect your tax receipts to be increasing, you expect your deficits to be decreasing, etc., etc., and we get the exact opposite. Theoretically speaking, in a booming economy, yeah, right.
Yeah, when I get challenged on that, my quick comment is, tax receipts don't go down when the economy is growing. They don't. They go up. So, and payroll receipts recently have been falling as well. So much for full employment. Yeah, all these guys burger flipping at McDonald's. There's 100 million unemployed in the US. The data, the government statistics are being served up to us in a certain manner to convey a certain narrative to justify higher interest rates, because they need the ammunition for the coming crash. Fed has already signaled on multiple occasions that there's a crash coming. They've been at pains since, I think it's about April, May, to take every opportunity to bash Trump's policies, which be it foreign, trade, fiscal, regulatory, immigration, and citing everyone as a potential risk to the economy. And then fast forward to August, and Powell speaks at Jackson Hole, and then in the August FOMC meeting, The first paragraphs of the August FOMC meeting minutes were all about the alternatives to rescue the markets and the economy in the next crisis. What does that tell you? The first thing they talk about is what are we going to do when the proverbial hits the fan? And then
and we already know from the past, if you remember, and I remember that very vividly because it surprised me, when
Yes.
it was uncertain that we had entered the previous recovery somewhere at 2011 or whatever, I explicitly remember the Fed leaking plans about helicopter money, which tells us that they already knew that quantitative easing would have side effects, and they were already planning, because a lot were afraid that actually the recovery would fail before it took off. So they were already planning at what do we do next, which is, since the trickle-down economics didn't actually work, perhaps we do the exact opposite thing. So we already know that they have in their drawer several plans about it. But my only question, my only disagreement, because we agree in too many things. I mean, it's it's sometimes it's good to disagree with people because you can have a debate. My only disagreement with you is the following: you said that perhaps a Fed that will turn more dovish is going to help the markets go higher. My only doubt here is the following: the market at the moment, let's say, is showing in good faith that it is believing the success story of the Fed. We did what we had to do, extraordinary measures. We inflated our balance sheet to 4.3 trillion, but don't worry about it because we had an exit plan. We're already executing it, and so far everything seems to be okay. I'm wondering, when the Fed shows that it's about to capitulate, is that actually going to be interpreted by the markets as a bullish signal, or the markets are suddenly going to wake up to the idea that, oh, wait, they will never unwind their balance sheet. They will have to go to the next round of QE. So why do we trust that, this thing is going to work out? I mean, as it seems, our faith that the previous time it would was unfounded. So I'm thinking that perhaps when the Fed capitulates, we're going to get the biggest sell-off, and it also goes contrarily to what the vast majority believes, that which makes me like it even more as a thesis. Now, I don't know what you think about this as a potential outcome.
No, it's a valid one, and I would actually fast forward to, I don't think this is the main crash. This is a 30% drop. It's going to feel painful to a lot of people. But this isn't the big event, in my opinion, as I discussed with Dale back in February. The collapse.
It's the end of next year, isn't it, David?
Well, 2020-21 is the collapse, and it's for the reasons that you outlined, Stylianos. It's that, they have no alternative. What else can they do but print money? There's nothing else these guys can do. So they're going to print on steroids, and the government's going to resort to helicopter money. There's 4 candidates at the next on the Democratic side for the next presidential election that are also already talking about universal income benefits. They have no alternative. So I think the market will take the approach that you did. And initially there will be a euphoric response. Great, more liquidity, yay. And then they'll go, wait, hold on a second. How long are we going to buy this story? It doesn't work anymore. We've seen it, and we're back to it again. Obviously, this doesn't work, and they have no other alternative. So where's the end point? A destruction of the dollar. Well, I don't want to be in U.S. assets if the dollar is going down. So I agree with you further out, but here's the other side of that coin. The Fed put, Powell has been, I mean, it's well documented, and a lot of discussion has gone on this, is where is Powell going to support the markets? And given the recent downturn, if you think about 2017, we had one-way markets, and pretty much during the Obama era, and that's what Trump was alluding to pre-election. And now we have two-way markets again with a lot of volatility. And actually the end point I was going to make today is volatility is returned, and it's going to get worse. But we got a lot of volatility. So the market's trying to figure out, is there a Fed put and where is it? So I think actually if the Fed were to pause, which I doubt in December, I think they're going to go ahead. But if they pause and reverse, then they will revert to the previous monetary policies, and they'll start cutting rates and start pursuing QE, and the market will respond euphorically. But how long does that euphoria last? I don't know. And that was one of the purposes of QT. It's the Fed's way of saying, look, our policies worked, everything's great. Look, we were able to reduce our balance sheet. We need to do it again, but it worked last time, so let's, it should work again. But the market's not going to buy that the next time around. So I agree with your point, but I don't have as much faith in the markets as you. I think they're going to buy it again. I think it's going to provide liquidity to the markets again. I think the banks are going to use that to buy up stocks again. And then, the rubber hits the road in 2020, 21. And the main casualty when we do revert to those policies will be the dollar.
Oh, there's no question about it. There's no question about it. I've said a billion times, I'm so bearish the dollar in the long term. I see no way that the dollar can be bullish in the years to follow. I mean, it can be in the short term. In the short term, it looks fine. But I see no way that they can escape with not completely evaporating the economy without destroying the dollar.
Yeah, David, let's take a look at the linchpin. The dollar really is the key that's, caused the emerging market problems, and, also the yuan gold peg, which you could probably just wait for the yuan to get to the levels you were talking about earlier. And once that top is in, you could buy commodities with both hands.
You could buy everything with both hands except the dollar.
Everything. Okay, stocks, commodities, everything.
Yeah, okay. Bonds, the whole kit and caboodle, because when the Fed returns to QE, they're going to be buying bonds. That's why they'll drive down yields. They have to, otherwise the U.S. economy and U.S. budget collapses. They'll prop up stocks too. But
so
yes,
could we do that? Just wait for a sell signal in U.S. dollar yuan, and know when that's happened, the dollar high is most likely in.
Well, that's what I've been pounding the table on this with regard to gold. Everybody's trying to call the bottom in gold and say it's going higher. I've had people, questioning, is the peg still intact? It's not tracking the dollar yuan as much as it used to. Yeah, but the gold was never about just the dollar yuan. As all of you know, from an FX perspective, there are two variables on the right side of that equation, and one is the gold in Chinese yuan terms divided by dollar yuan. So gold in yuan terms rose, but how do I put it? The fact that Chinese yuan is driving the gold price in dollars, where it be against gold directly or against the dollar, has not changed. The equation, it's simple math, remains intact. So if you step back up from the details there, the developments between the US and China on the trade front are the sole driver of gold prices today.
Interesting. Yeah.
And I will get into that on gold. But going back to your point, I've said, I write for Sprott Money now. I've said repeatedly on there that buy when the stock market crashes, because, and when I say that, I mean, I specifically state when it's down 20 to 30%, you can pretty much anticipate that Fed put's going to be exercised, in my opinion. And that is the true peak in the dollar. It may have peaked beforehand, but it's going to send the dollar lower. And the dollar will go down against the Chinese yuan too, because you don't need you don't need tariffs or a trade war to get your trade balance, your trade deficit down, because a weaker dollar will do that for you. So it renders tariffs redundant. There's no need for it anymore. You're going to get a stronger Chinese yuan and a weaker dollar. Hey presto, everything's good. I've been praying for an overnight dollar to yuan devaluation to 740, 780, and everybody's, what'll that, gold will crash. No, it'll be devalued against gold as well. That's the way devaluations work. It doesn't devalue against the dollar and nothing else. It devalues against the dollar on a daily basis. If I'm talking about an official overnight devaluation, would be ideal if Trump imposes 25% tariffs on all Chinese exports and Chinese come out a week later and say, okay, we've devalued the Chinese yuan 10% overnight. I would remortgage my house 8 times and buy gold at that point, because that would be peak dollar yuan, because it will cause such global turmoil that the Fed will be forced to reverse policy, and down goes the dollar. So you get a dollar pop instantaneously, and then down goes the dollar. But to answer your point, yes, that is the bottom in gold, and I don't see it yet. I have I don't put any credibility in any of these statements that we're getting publicly about, oh, we're closer to a trade deal, we're close. And then the next day something comes out, oh, no, we're not. We're in, we're out. We're in, we're out.
And the big dollar devaluation, if I may add, David, is what will actually perhaps will save the US indices from collapsing completely in nominal terms, because they will be collapsing in real value, but they won't collapse that much in nominal terms.
Yes, that goes back to Luke Roman.
That's all it was at the beginning of QE. Dollar depreciated 30%. The market was up 30%. Yes,
and that makes sense. I mean, stocks love inflation, but as Luke Roman pointed out, and a fellow Irishman, Louis Curran, it speaks to the Fed's trilemma. When the proverbial hits the fan, the Fed they focus on three things. They focus on the stock market, the bond market, and the dollar. Their number one priority is the bond market, because the risk-free rate drives everything. If the bond market collapses and yields were to go to 10%, the U.S. government balance sheet, they're toast. There's talk about insolvency, yada, yada, yada. Already foreigners aren't buying treasuries. So imagine what happens if interest rates would go dramatically higher. So that's the number one priority. Stock market's number two, and the dollar's number three. Now, as long as they got this Goldilocks scenario where, they keep the dollar up and they keep stocks up, and bond yields go up, but not, it's manageable, they're fine. But the minute that stocks collapse, because stocks are 150% of GDP in the US, they are one of the primary drivers of federal tax receipts via capital gains and IRA distributions. You can chart this. They need to rescue the stock market. This is why I believe they will come back to rescue. I have no doubt that they will step in. Otherwise, it's complete collapse. And I don't see that just yet. They'll do it again. They'll rescue the market again. So when the time comes and stocks fall, say they fall this 30% to 2,100, Powell turns around and says, okay, we're done reducing the balance sheet. We're going to pause on rates. And then if it continues to fall any further, they'll start cutting, and then they'll revert to QE. The point being, QE will prop up the bond market because they're buying US treasuries because nobody else will. And I believe they're going to likely start buying stocks, just like Bank of Japan has been doing. And that'll drive up the stock market, to your point. But which is the casualty? You only get 2 out of 3. The casualty is the dollar, the global reserve currency. And it'll last for a while, but once the dollar loses its reserve currency status, and it won't be the US voluntarily going, oh, we give up, let's try something else. It'll be the rest of the world going, we don't think so. This doesn't work anymore. Led by the IMF with China and Russia behind them. And that's what China and Russia, this all connects. That's why China and Russia have been loading up on gold for over 10 years now. They know what's coming for the dollar. They know there's just too many problems coming to. You've got the unfunded liabilities that Ray Dalio has been talking about. We don't have a debt to GDP of just north of 100% in the US. It's more like 1,000% when you include the unfunded liabilities. They're waterfalling onto the US balance sheet in 2020.
They're much smaller, but let me add here the contingency liabilities. For example, which would be illegal for a company. I know that you're CFA, so you know that very well. Any company has to have contingency liabilities. The US chooses not to do so in its budget, so that is what creates the end result of reporting, let's say, $730 billion of a fiscal year deficit, but at the same fiscal year, they need to borrow 1.2 trillion. What is the rest? Of budget items, right? Yeah. Because they don't even include contingencies. I mean, every year they have distractions like fires, hurricanes, but none of that is included in the budget, saying, okay, let's go back 10 years and see on average how much, let's say, we spent on natural disasters. That much. Okay, put it in the budget. You know what I mean?
Yes. But I will say that those numbers are correct, because they're not just Ray Dalio, the Congressional Budget Office provided them. Debt to GDP is north of 1,100% when you included unfunded liabilities in the numbers. I can send you the charts, to be honest. So
and they're increasing exponentially by the month.
Yes, exactly. And this is the point. The Chinese and the Russians know what's coming. But my point, what I was coming back to, is the dollar is the linchpin. And when the dollar falls, and I believe it's at least peaked in the short term, it may have peaked already, but there is a risk to 101.60, and I was going to get to that later on the Dixie, but it could have peaked already, or it's just a short-term peak. But when the dollar falls, gold rises, and I'm including dollar won in that. And there's no need for a trade war. There's no need for tariffs, because the U.S. exports will be cheaper in won terms, and won exports to the U.S. will be more expensive. So dollar won can fall at that point, and that's when gold goes higher. But
hey,
stocks,
David, I wanted to ask you in relation to gold. I know you'd advocate to everyone to hold physical.
yes.
Do you do any work on balance sheets of mining companies to know that, which ones will have survivability during this, last final decline, and who knows how fast it comes back once we bottom? Because you could be right about the gold market and buy a mining company that does reverse splits or goes BK. Do you do due diligence on miners?
I do not. There's only one of me, and I can only spread myself too thin.
Okay.
But what I do, Dale, is I try to use a Ronald Reagan approach, and I'm not a Republican or a Democrat, but I do like his approach, where you find the best people, the experts in various areas. And there's a gentleman called Luis at Economic Alpha on Twitter, who has pointed me in the direction of Kirkland Lake. When it was at, I think, $3-4, and it went to over 20, and
Wow.
also pointed me in the direction of another small company called Wisdom, and I'm up, I think, 40% on that one already. He does due diligence. He meets with the CEOs. He goes to the conferences. I don't know if he's an accountant by trade, but he goes through all of the data, and it's not just me. A lot of people follow him, so he's my guy, if you will.
Okay.
I asked him the same question yesterday.
Yeah, you do intelligence gathering. I know I've been to your Twitter feed, so there are people that, none of us, there's nothing new under the sun. So all of us, we may think that it's an original idea, but maybe it's just a composite of all the things that we read and take in and talk to, and then we have to see it ourselves. So I respect people that respect others' work, and you're right, you can't do it all.
Yeah,
So
and
leave his Twitter handle in my DM box later on, okay?
I will, at Economic Alpha. But I will say this just a quick. Yeah, I like the guys that posted something on this briefly recently. The guys that follow data and a process and never succumb to emotion. So you get a lot of price chasers out there. Gold, when we were up at 1240s, oh, we're going back to 1300. I'm like, no, we're going back down again.
Yeah.
And why? Oh, well, here's the data. Here's why: A, B, C, D, E, and there are several of those around. And
I'm thinking 1120.
1124 is what the number I have on the downside. Yes.
Oh God, here we are. Okay.
Yeah.
So all right.
Let's go back to stocks so we can get through I just want to say, there are two other.
Don't you want to talk for another few hours? Steve could ask about 20 more questions of you.
Well, I'm trying. I want to get as much talk about as much as possible that would be beneficial to you and the listeners. But the other scenario is that we do go to a expanded flat, we go to 3,000 plus. This is the second scenario whereby we never completed wave 3 up, and this is actually the expanded flat of wave 4. We're completing that. We completed that at 2,600, and now we're going back up in wave 5. And I actually prepared this a couple of days ago, so this level has worked out well, 2683. And then once we hit the higher high, then we go lower. This is less. This is not my primary. Yeah, this is not my primary scenario. This is less probable in my opinion, but I throw it out there. If we go to 3,000 plus, it could be the top of wave 3, and then we do our ABC down to 2,100. That obviously would delay the crash. But this is, I'm just throwing it out there.
6 months it would.
Yes. And
into the spring or so.
But it is out there. If you look for it, people are talking about this alternative scenario, and it is valid, but I just don't see it right now. And the last one I have on stocks is we just go straight down. We break 2683. We've done our ABC. Our B was right here. Yeah. That was your B, and see you later.
61.8 right there to the number.
And then we go. That's alternative number 3. but I just don't think so. I think they're going to come up with another reason to get this market going up again, and then the plug will be pulled, because you've got the buyback with the FOMC on December 19th, the G20 on November 30th, and you got the buyback blackout period coming in January. You've got so many catalysts coming, but that buyback blackout period looks, I mean, given what happened in October, it looks ideal. You get a nice rally on November, December, and then everybody's feeling groovy again, and then whack, January. Or December 19 when the FOMC raises rates again, and maybe they're hawkish, and down we go. But I do see a rally here in the short term, but as Stylianos and Andre were talking about earlier, it has to hold 26.83.84, or worst case 26.30. Otherwise, it looks like we're going down further. That would be my 2 cents.
Okay.
Now, let me finish by saying, whatever route we take, whether we go straight down, we go up to a new higher high at 3,000 plus, or we hit one of these levels, 28.20 again, 28.60 or 20, the end point is the same. There's a crash coming. There's no two ways about it, in my opinion. Now, I could be wrong, but there is whatever route you decide to take going up Everest, assuming you get there, it doesn't matter which route you take. It's the point is you get to the same destination, and that's what the situation is. You're going the opposite direction. Is 2100, 2200 on the high side in the S&P, in my opinion. So,
okay.
If there's nothing else on that one, let me switch to gold here quickly, and I just want to address a key point, which I've tried to communicate to people on Sprott Money, but the principal driver of gold remains developments in the US-China trade war by way of the Chinese yuan. And I think this is best illustrated here by looking at, I'll look at 2 of these 3, but the reasons why gold rallied on October 11th and November 1st. If you look at these 2, this October 11th rally basically constituted much, if not all, of the rally for the past, since August.
A month. Yeah.
Yes. So what happened on October 11th? The US came out and they said, "Oh, we're going to meet with China again on trade, and we're going to do it at the G20." And the Treasury made a decision not to label China a currency manipulator. Those are the 2 big olive branches the US extended to the Chinese, and everybody jumped all over it, especially gold. Well, what happened the very next? Well, let's look at what happened to dollar Chinese yuan. To illustrate the point, the dollar yuan dumped, which is good for gold.
Right.
And at the same time, the gold in yuan terms rose. That's the perfect combination for gold. Gold in yuan goes up, the numerator, and dollar yuan, the denominator, goes down. So gold and dollar prices goes north. But look what happened the very next day. It started going back up again, the dollar yuan, that is, and the Chinese yuan, yes, we'll get to that, it went up to a peak in October 26th. But the point is that gold got its pop on October 11th, and it went up a bit further based on the, it went up a little further based on the continued rise in the gold in yuan terms, but it gave them back again here when we got news that, everything wasn't so great. First of all, the Chinese rebuffed the idea of a meeting under threat of sanctions or tariffs, and that evening they fixed the Chinese yuan at a lower rate against the dollar when everybody expected them to fix it at a higher rate in response to the US olive branches. Well, they did the opposite. So it gradually went higher thanks to gold in yuan terms, but eventually that caught up with it, and we went back down again. And that was driven by the dollar yuan rising again. So fast forward to November 1st. We got news that we had a meeting between Chinese Premier Li and several senators from the US. It was all very nicey. Everybody got along well. China is a great country. We love you guys. And Kudlow then came out in the US at the same time and said, the fact that we're talking about more tariffs doesn't mean that they're necessarily going to be put in place. They're not set in stone. And again, gold went up. November 1st, nice big white candle. Again,
every time I see Larry Kudlow, David, I just have to tell you a story. I interviewed him while I was on FX Street during the campaign phase of the presidential election.
Right.
And I asked him, I said, Larry, what do you think of the Trump candidacy? Do you think he has a chance to win? And he said, nah, he's not doing things right. And now here he is. Isn't that something?
Yeah.
He didn't think he had a shot. Now he's his mouthpiece. It's pretty funny in my mind, anyway.
Well, it is very funny, but I'm trying to stay away from a comment that I want to make on here.
Okay.
In society today, it's amazing how many empty vessels make it to the top. But anyway.
Good one. Oh, I like that. All right.
So then that was on November 1st, and then the next later that evening, this is what we get. Don't expect a trade deal with China at the G20. And again, we're disappointed. And then you get more awful headlines. This one was from Navarro. They muzzled him yesterday, but he still got this one out, where like economic security is, and by the way, this is the truth probably, but they don't want this going out. Economic security is national security. If China stopped stealing IP, it would lose its economic edge. If China undertook structural changes, US asking for it would be existential change for China. He also dismissed the prospects of a deal, accusing China of wanting to tap dance. Conclusion: there will be no breakthrough in the Trump-Xi meeting either in November or any time in the foreseeable future. That is the unvarnished truth. And they muzzled him yesterday because they don't want that going out, because there's no way these two sides can agree. The China want to make China, the greatest country in the world in 2025. The US doesn't like that because they want to make America great again. And these guys are too entrenched. So a resolution will have to be forced on them. And then Pence came out and said this is how, and everybody says that the US is sweating and the US is like going to blow up. They have to agree. I've been saying since day one, US doesn't seem to be like bothered at all. We can do this for as long as we like. We're in it for a protracted war. And when I see these comments from the US, it seems to reinforce that. Pence comes out and says this. After the Chinese are saying they won't agree to anything or negotiation anything with a knife to their throat. And then Pence says this: the Trump-Xi meeting at G20 may be China's last chance to avoid Cold War II. U.S. is prepared to exert maximum pressure unless Beijing agrees to significant economic, military, and political changes. I mean, do you guys not are they not getting the messages from China that the rest of us are getting? Because this is not going to work. Or maybe they don't want an agreement. Maybe they want this to escalate further. But I think these headlines that we're getting, the positive headlines, are solely designed to prop up stocks. But the reality is the likelihood of an agreement between the US and China at the G20 in November 30 is small, to put it mildly. And then we have the White House muzzling Navarro because he told the truth. And now we get I was just threw this in. This is the latest headlines where like, oh, look, we're talking. Isn't this wonderful? And I gave my comment at the bottom there. Yeah. Another cry wolf scenario. So the point of all this,
Xi doesn't have to run for re-election. People forget that. President Xi does not have to run for re-election in 2 years.
Right. He doesn't. But the Chinese are relying on a stock market crash, and they can literally make one happen overnight. If they devalued the Chinese yuan against the dollar tomorrow, what do you think happens to the S&P 500? It would drop like a lead balloon.
2,100.
So if you've got a bazooka pointed at the guy on the other side of the table, you feel pretty comfortable about the negotiations. My point is that gold is still driven by developments between the US and China on the trade front. It drives the rallies and then it drives it lower. The downside, unfortunately for me, why I was one of the few lone people saying that it's going to go lower when we're at the 1240s, is because I don't see any resolution of this until we get a US stock market crash that forces the Fed to reverse policy, whereby the dollar falls against basically everything, including the won. When the dollar-won peaks, gold bottoms. We saw the opposite on April 11th, and now I believe that'll be it. And that's my primary scenario for gold going forward. That's why I agree with you. I think 1124 is the bottom. Just quick comment, dollar index, I believe this is topped, at least in the short term, from a sentiment, technical, and positioning perspective. We could see a pop if there's a stock market crash from a safe haven perspective, but at least in the short term, this goes down, which would prop up stocks, another reason for stocks to go. WTI, love Andre's Fibonacci numbers. I couldn't agree with them more. I see 66, 50% retrace for this.
That would help the market too.
Yes, and just above this previous support level, it'll be a false dawn. We're going down to the 40s, in my opinion, but see a bounce to 66, at least 63. And you can see why. I mean, it's so extreme over bearish. It's bearishness and oversold levels are the same as January 2016. We all know what happened in January 2016. We had the worst January.
We bought it, David, in ForexAnalytix the day before yesterday after this capitulation. I think this last candle down was a capitulation candle. I agree with you. This kind of a move lower definitely will bring more weakness. But I do believe that I don't know if you monitor the DSI, but the DSI actually hit 4.
Yes, I do.
Scale to 0 to 100, we actually hit 4 on the DSI. So it not only oversold on momentum indicators like the RSI, but also sentiment went from extremely bullish like several weeks ago to extremely bearish in such a short period of time, almost 30% down. So I do believe the area I'm looking for in this rebound, I'm still long actually, crude. The area I'm looking for is 63.60 to 64.40. I have a nice confluence of resistances there, so I do believe we can make it there. At least.
Exactly. That's my first target, but I see a possibility of 66, just above this huge support level.
Yeah, absolutely.
And then we go down. But I agree totally with you. And yes, DSI is one of my primary tools. I use a whole bunch of them, technicals, sentiment, positioning, But DSI, it was 4, I think back in, it was either January 6th or January 14 of 2016, it was 4. And back in August 2015 as well. So what tends to happen, as is I love positive divergences for bottoms and negative divergences for tops. We got that in Dixie a couple of days ago when it hit 90, I think it was 91. But I'd love this to go up, back down again to the 40s, but we get a positively divergent low. Because I see when we get this stock market crash, oil's going to go down with it. And you could go down to the 20s even again, but I'd be happy with the 40s or high 30s. But I see triple digits in 2019 when the dollar gets crushed.
Yeah, due to the dollar's crash. No, there's no question about it. I also believe I would be buying crude near the 40s, both hands. I mean, I would be stockpiling it at my balconies.
Exactly. I'll do what you bought it 2 days ago. I bought it 2 days ago. I bought call options on the USO, but we're in the same boat. And
you could buy the S&Ps right now too, because they went to the number I was looking for, and we're getting a nice reversal candle.
Excellent
confirmation. Yes. So your scenario will, I think, play out, David. What a great interview, because the three of us, great questions. You've been here an hour. Anything you want to add to wrap it up, or?
Yeah, I just want to finish on this one, Dale. The bonds, because Stylianos and Andre talked to it earlier. I sent a little chat tweet, and I basically wanted to say this. As you can see from my chart, which this is from a few days ago, it's playing out as expected. But I expect bond yields to go back up again, because I think bond yields will peak when stock market rally peaks. And then when the stock, just like in 2008, when the stock market takes a dump, then bond yields go down. Now, in this case, I don't think bond yields go back up again, because when the Fed reverts to QE, which I still think they will, it's just 30% down on the stock market. They're going to buy bonds, and then bond yields go even lower. So I think bonds usually not focused on a lot because they're not sexy, but when this thing bottoms, I see it taking off, and you buy deep out of the money calls for 120.
TLT?
Yeah, 122 or higher out to, you get good prices on them out to June, because I see this going to 130, 140. I see it going sub 2%, because the.
So you think we could get one more shot down? That's the way it looks to me, and one more shot up in yields, or the low is in TLT.
One more shot up in yields.
Okay.
And
330, 335, 10 years, something like that.
Exactly, 330, 340.
Okay.
And then look out below in yields, look up.
And then you could short the yen when that's done too, right?
You could, but
115.
Short dollar yen, you mean? Yes, I want to buy yen. Yes, yeah, absolutely. Right. Yeah. No, we're on the same page. So yeah, that's all that's the last part I wanted to give you. Those are the biggies. I said gold to 111.24, S&P to 2100, 10-year, 30-year down to 2%, maybe lower, 2% handle. And then the Dixie peaked, and I believe it's going down to the 80s and 70s. Dollar yuan is going below 100 again. Dollar yen. And yeah, interesting times ahead, and a lot of volatility. There's going to be a lot of, you ain't seen nothing yet.
Yeah, what a great time period for traders.
Finally. Yeah, I was on the snooze button for all of 2017.
Yeah. You know, well, I'm glad, just like Rip Van Winkle woke up after 20 years, you woke up today to be here with us, David, and really appreciate all of your insights. And people could follow you on Twitter at Global Pro Trader. And that's also David's website, right? www.globalprotrader.com. Correct?
Just add an S. Just add an S.
Oh, traders. Okay.
Yes.
Okay. That's different on the website than it is on your Twitter handle.
Yeah, they wouldn't give me enough characters on Twitter. And I'm only one, unfortunately. I wish I was many. But yes.
Yeah. So David, thank you so much. I know you're in Canada. I wish you a great holiday season and a prosperous one. And thank you for prepping us, because everything's about having the right mindset so that when these things manifest on our screen, we're not doing the analysis, but we're executing. So thank you very much, David, my trading warrior brother, for coming back to face.
I enjoyed it as well.
Well, thank you, guys. I really appreciate you having me on, Dale. I really love these conversations. And I will say one last comment with regard to what you just said. It's better to prepare earlier than later. And given what's coming, I recommend, I said this with regard to gold, I still think it goes to lower lows, but not much lower. If you don't have any, buy some. At least buy a few silver coins. It's $20 for a 1 ounce coin of silver these days. Buy some.
Thank you, David.
Thanks, guys.
And I have a few coffee cans to fill up myself. So thank you very much, David Brady, my trading warrior brother, one of Face's favorite guests. Good luck, David. Keep in touch. And I want to thank you again, and thank our viewers at investing.com and Face people. And we'll wrap it up tomorrow with TGIF. And remember, even if you catch all these swings, don't just count your pips, count your blessings. And we'll see everyone tomorrow to wrap up the week. Adios, and thank you again, David.
Thanks, Dale. Thanks, Julianos.
Thank you, mate. Bye-bye.
Thank you for your help today, Steve.
It's a pleasure.